Hi friends, welcome to Smart Money Tips. We often want to choose best options available in every field, but sometimes due to lack of clarity, we tend to make wrong choice knowingly or unknowingly. We understand that tax planning is a critical process, and keeping this in mind, we have made today's video which will help you in choosing the right investment product for tax deduction under Section 80C and 80CC D1B. Under Section 80C, a deduction of Rs 1.5 lakhs can be claimed from your total income. In simple words, you can reduce up to 1.5 lakh from your total taxable income through Section 80C. And Section 80CC D1B gives you an additional deductions up to Rs 50,000 for the amount invested by taxpayer in their NPS account. If you wish to know in details about how to do a tax calculation, please watch the video from here. Also, do not forget to subscribe Smart Money Tips and press the bell icon for more finance related videos. So let's begin. To make it more easier and simplified, we have made different parameters which will help you in understanding which tax saving investment product you should choose. First parameter is investment type. In this we will see various product class and their objectives. Second parameter is return. Here we will see how much return we can expect by investing in each product. Third parameter is risk, and this will tell us how much risk these products carries. Fourth parameters would be lock-in period, and this will talks about whether your investment is lock-in or not, even if lock-in, for how many years. And the fifth parameter is tax on returns. This parameter will help us in knowing whether you pay tax on the returns you generate from your investment or not. And the final parameter will be suitability. So this will help us in understanding who should consider investing into this product. The first investment product is tax saving fixed deposit. Tax saving fixed deposit are fixed deposit schemes offered by banks and post office that allows tax deduction under Section 80C up to 1.5 lakhs rupees. Returns in tax saving FDs for regular investor is between 4 to 6.5%, and for senior citizen it is between 4.5 to 7%, and it varies from bank to bank. Tax saving FDs are generally safe and carries very less risk. And there is a 5 years lock-in in tax saving FD. There is no premature withdrawals, no loans, and no OD facilities are available against tax saving FDs. Tax saving FDs are taxable, means whatever interest one earns, he or she entitles to pay tax on the earned interest according to their income tax slab. There is a rebate on earned interest which is 50,000 rupees for senior citizen and 10,000 rupees for regular investors. Tax saving FDs are suitable for those who do not want to take risk and wants a fixed and regular interest. Second investment type is Employee Provident Fund or Public Provident Fund. Employee Provident Fund is a scheme where employees contribute a fixed amount every month, that is 12% of basic salary per year. On this contribution amount, he or she gets a deduction under Section 80C up to the amount of 1.5 lakh per year. And PPF means Public Provident Fund, and it is a savings cum tax saving instrument where one gets deductions under Section 80C up to the amount of 1.5 lakh per year. Returns in EPF is 8.5% at present, whereas PPF interest rate is 7.10, which keeps on changing over a period of time. EPF and PPF is a Government of India operated savings and investment scheme, so it is quite safe investing in these. Now, employee provident fund are generally designed for retirement purpose and they are long-term in nature. You only can withdraw partial money from your EPF in few exceptions, like on medical treatment, for children's higher education or marriage, or for house construction. And PPF has a lock-in of 15 years. After budget 2021, if deposit in EPFs and VPFs by an employee exceeds 2.5 lakh in a financial year, then the interest earned on the contribution which exceeding 2.5 lakhs will be taxable in the hand of employees. In case if there is no contribution by the employer to the EPF account, which usually in the case of government employees, then interest will be tax exempt for the deposit up to Rs 5 lakh in a financial year. EPF interest rates are quite attractive and tax free. You should definitely consider contributing at least up to 2.5 lakhs in EPF. Now the third tax saving investment product is life insurance. If you invest in life insurance policy, you are entitled to get deduction under Section 80C on the premium up to 1.5 lakhs rupees. Life insurance policies returns are generally fall between 3 to 6%, and it varies from product to product and companies to companies. Only ULIP's returns are market linked. You can watch a detailed video on life insurance from the link. Investing in life insurance is safe because insurance companies typically invest monies in fixed income instrument. Only ULIP participate in equity market, so it is quite risky. Most of the life insurance products are long-term in nature. Few products carries lock-ins, while in other product, investor can withdraw money before maturity by paying some penalties. Talking about tax on returns, generally most of life insurance policies returns are tax-free under section 1010D. Investors don't pay any tax on the returns they generate. There are few exceptions. I personally is not a fan of life insurance for investment, and the simple reason for that is one, long-term commitment, and second, returns are hardly beating inflation. I always advise term plan when it comes for life insurance because the literal purpose of life insurance is to provide financial protection to the family. Fourth tax saving investment product is Sukanya Samridhi Yojna. Sukanya Samridhi Yojna is a government of India backed saving schemes which encourage parents to build fund for future education and marriage expenses for the girl child. If you invest in Sukanya Samridhi Yojna, you are entitled to get deduction under section 80C on the premium up to 1.5 lakhs. Sukanya Samridhi Yojna currently offers an interest rate of 7.6% and interest rates are revised every quarter. It is backed by the government of India, so it is quite safe investing in Sukanya Samridhi Yojna. Sukanya Samridhi Yojna has a tenure of 21 years. However, partial withdrawals and premature closure is allowed in case of higher education or marriage. Sukanya Samridhi Yojna comes under triple E category where the deposits and interest earned at the maturity are tax-free. If you have a girl child, you should definitely open a Sukanya Samridhi account. And the fifth tax-saving investment product is ELSS, Equity Linked Savings Scheme. ELSS is a mutual fund class that offers a tax rebate under Section 80C of Income Tax Act up to the amount of 1.5 lakhs per year. ELSS mutual fund have the potential to offer highest returns among all Section 80C investments, though returns completely depend on the performance of underlying stock in the ELSS scheme. ELSS are market linked and risky in nature. Consult expert before taking investment decisions. ELSS has a least lock-in among all other 80C investments. ELSS has 3 years lock-in. That's the reason maximum investors consider ELSS for tax-saving investment. In ELSS, if returns exceed 1 lakh rupees, then investor pays 10% tax on over and above 1 lakh rupees. So, long-term gains are taxed at 10% over and above gains of 1 lakh rupees. ELSS has the probability of generating higher returns, and if gains are less than 1 lakh, you technically pay zero tax. Lock-in is just 3 years, so you should definitely consider ELSS over others investment product. These all are popular known tax saving investment options under Section 80C, and apart from this you also have Senior Citizen Savings Scheme, which is designed for senior citizen, and amount deposit is eligible for tax deduction under Section 80C. And the current interest rate of Senior Citizen Savings Scheme is 7.4% and interest rate is revised every quarterly. This is a government backed retirement program, so it's a quite safe investing in this. And there is a 5 years lock-in here. Interest on Senior Citizen Savings Scheme is taxable as per the tax slab of an individual. There is one more product. You can also invest in National Savings Certificate for tax deduction under Section 80C up to 1.5 lakhs rupees. Apart from this, if you have a housing loan, then you can claim a deductions for home loan principal repayment under Section 80C up to 1.5 lakhs rupees. Also, if you are paying tuition fees for your children, you can claim up to 1.5 lakhs rupees as a tax deductions under Section 80C. So there are various tax saving investment options available. I hope you got a fair idea about which product you should choose. If you still have any questions or suggestions, please pen down in the comment box, or you can also reach to us at below details. Thanks for watching. Stay safe, stay healthy.